You sit at your desk. The market's moving and your hands hover over the keyboard, trembling just slightly. In this exact moment, you're not thinking about price action, or support levels, or the technical setup you spent 3 hours analyzing last night. You're thinking about what happens if you're wrong again, what it means if this trade fails like the last one, what it says about you if you can't make this work after everything you've invested. The rent is due in 8 days. Your partner asked about the account balance yesterday, and you changed the subject. Your father still thinks this whole trading thing is a phase, and somewhere in the back of your mind, underneath all the noise and fear and desperate hope, a question burns. Why do some traders make millions while you're still fighting to stay consistent? You've read the books, watched the courses, studied the charts until your eyes burned, but nothing's working the way it should. The answer to why isn't what you think, and it's going to make you uncomfortable. Because the difference between a millionaire trader and someone who quits after 2 years isn't intelligence. It's not access to better tools, or secret strategies, or insider knowledge, or special market insight. It's something simpler and infinitely harder. This is the moment that separates the two paths, the moment your brain decides whether you're about to execute a trade or betray one. And the worst part? You don't even know it's happening. Most traders walk through life believing that millionaires have something they don't, a proprietary indicator hidden behind a paywall, a special pattern that only works on certain time frames, some edge that retail traders will never access. It sounds logical. It feels true. It's what every course seller and signal provider wants you to believe. But it's a lie that keeps you searching when you should be simplifying. The real edge millionaire traders have isn't technical. It's not about chart mastery or order flow reading or advanced market microstructure. It's neurological. They've learned to think in a way that protects them from themselves, from the emotional cascade that destroys everyone else, from the biochemical hijacking that turns intelligent people into impulsive gamblers. Because what kills traders isn't bad strategy. It's what your brain does when money is on the line. When real capital is at risk, and your heart is pounding, and cortisol is flooding your system, and every instinct is screaming at you to do something, anything, to make the pain stop. That's when the millionaire trader and the struggling trader reveal who they really are. Before you place another trade, stop. Write down your complete business plan. Not your strategy, your business plan. What percentage of your account will you risk per trade? What's your monthly profit target? What's your maximum monthly loss limit? What days will you trade, and what days will you stay out? How many trades per week is your maximum? Write this down and tape it to your monitor. A business without a plan is just expensive gambling. Let's talk about what trading actually feels like when you're losing. Not the sanitized version from trading books, the real version. You open your platform, and the plan is crystal clear. You've written it down, reviewed it twice. Wait for your A+ setup. Execute with discipline. Manage risk with predetermined stops. You're going to be different today. Today is the day you finally trade like a professional. But the morning starts slow. No setups, just noise. Choppy price action that goes nowhere. By 10:15, you're bored, restless. The market's moving without you. And every green candle feels like opportunity slipping through your fingers. Other traders are making money right now. You can feel it. You're sitting here doing nothing while they're capitalizing. So you take a trade. Not your A+ setup, not even your B setup. Just something close enough. Something that scratches the itch. You tell yourself it's fine. It's still within your parameters. Sort of. It goes against you immediately. $20 down, 50, 75. Your heart rate climbs. Your breathing shallows. Your palms start sweating against the mouse, and suddenly the trade that was supposed to be a quick $50 win becomes a test of your identity. A referendum on whether you're capable, whether you're smart enough, whether you belong here. You tell yourself you're being patient, strategic, giving the trade room to work. But what you're really doing is hoping the market proves you weren't stupid for entering. This is where your brain starts lying to you. Because in that moment, you're not trading anymore. You're defending your ego, and your nervous system is flooding with chemicals designed to keep you alive in a jungle, not rational in a market. Your amygdala, that ancient fear center, is taking control. Your prefrontal cortex, the rational decision-making part of your brain, is going offline. And you don't notice any of it happening. This is why you need an emotional circuit breaker. After any losing trade, you must wait exactly 30 minutes before placing another order. Set a timer. During those 30 minutes, write down 3 things: what you're feeling right now, what you want to do next, and why that impulse might be wrong. This gives your prefrontal cortex time to come back online before you make another decision. Here's where it gets personal. Where we stop talking about theory and start talking about real people. Meet someone we'll call Peter. He's 34 years old, runs a small consulting business that gives him flexible hours. Smart guy, engineering background, reads constantly. Took 3 comprehensive courses on technical analysis before he funded his first account with real money. Peter's not gambling. He's not reckless. He's not one of those people who jumps in with no preparation. He's doing exactly what he thinks millionaire traders do: analyzing, adapting, optimizing, improving. He has a trading journal. He reviews his trades every evening. He's constantly refining his edge. One Tuesday morning in October, he's watching a stock he's been tracking for 4 days. Semiconductor company. Strong earnings. Breaking out of a consolidation pattern. The setup finally appears. Everything aligns. Volume, price action, market context, everything. But Peter hesitates, just for 5 seconds, just long enough to second-guess the entry point, to wonder if he should wait for a pullback, to question whether the risk-reward is really as good as it looks. The stock moves without him. He watches it climb 10 cents, 20 cents, 50 cents. His setup, his analysis, his trade, leaving without him. Frustration builds in his chest, that familiar feeling of watching opportunity slip away. So he chases it, enters late at a worse price, convinces himself he's still early enough, that the move has more to go, that he can't miss this one. The stock peaks 30 seconds after his entry, then reverses hard. Peter's stop-loss triggers. He's out. $127 loss. Manageable in the context of his account. But something inside him shifts because it wasn't supposed to go this way. He did the work. He analyzed correctly. He knew the setup, and the market punished him anyway for his hesitation. The loss isn't just financial. It's emotional. It's proof that he's not fast enough, not confident enough, not good enough. Now his body's responding, cortisol flooding his bloodstream, heart rate elevated, breathing shallow. His amygdala, that almond-shaped fear center in his brain, is hijacking his prefrontal cortex. The part of his brain responsible for rational thought, impulse control, and long-term planning is going offline. And Peter doesn't even notice. He just knows he feels bad and wants to feel better. He scans the market looking for redemption, looking for a way to prove that loss was a fluke. Another setup appears, probably a B setup at best, But Peter's brain isn't evaluating quality right now. It's seeking relief. He takes the trade. Larger position size this time, tighter stop because he can't afford another big loss. He'll just grab a quick win and be done for the day. It doesn't go his way either. Stop triggered in 90 seconds. Another $143 gone. Now Peter's down $270 for the day. His chest is tight. His thoughts are racing. And in that moment, watching his account balance drop, feeling his confidence crack, everything inside him quietly breaks. What Peter doesn't understand is that he's just violated one of the most fundamental rules of profitable trading. He needs to implement what professionals call the 3-to-1 rule, with absolute discipline. For every trade you take, your potential profit must be at least 3 times your potential loss. If you're willing to lose $100, you must have a realistic path to make $300. This single rule will force you to be selective about your entries and patient with your exits. Set your stop loss first, then calculate where your take profit needs to be. If you can't get 3-to-1, don't take the trade. Ever. Let's pause here and talk about what's happening in Peter's brain. Because this isn't weakness. This isn't lack of discipline or poor character. This is biology. When you experience an unexpected financial loss, your body releases cortisol, one of the primary stress hormones. Research on traders shows that cortisol levels can spike by nearly 70% during periods of market volatility and sustained losses. Cortisol narrows your focus. It shifts your brain into survival mode, into what neuroscientists call a threat response state. And in survival mode, you're not thinking about probability distributions or process over outcome. You're thinking about immediate threat elimination. At the same time, your dopamine system is misfiring. Dopamine doesn't just drive pleasure and reward. It drives prediction. It's what allows your brain to anticipate outcomes and adjust behavior. And when your predictions fail repeatedly, your brain enters what researchers call a reward prediction error state. Your dopamine neurons fire differently, creating a desperate drive to correct the pattern, to resolve the error, to prove the system still works. This is why revenge trading feels logical in the moment. Your brain is trying to restore equilibrium, but it's doing so emotionally, not rationally. Meanwhile, studies using functional MRI scans of trader brains show that chronic stress literally impairs the neural pathways in the prefrontal cortex responsible for executive function and rational decision-making. Your amygdala takes over, and the amygdala doesn't care about your trading plan or your risk management rules or your long-term account growth. It cares about eliminating the feeling of threat as quickly as possible. This is why you can backtest like a genius and trade like a beginner. Your brain isn't malfunctioning. It's doing exactly what evolution designed it to do over millions of years. It's protecting you from danger, just at the worst possible time for your trading account. The solution is a stress monitoring system. Before each trading session, rate your stress level from 1 to 10. If you're above a 6, cut your position size in half. If you're above an 8, don't trade at all. Your emotional state directly impacts your decision quality, and position sizing is your best defense against emotional trading. Back to Peter. He forces himself to close his platform at 2 p.m. 5 trades total. 4 losses, 1 small win that barely registers emotionally. His account is down 6.2% for the day. Not catastrophic, not a blown account, but enough to sting, enough to hurt. He tells himself he'll review the trades tonight, figure out what went wrong technically, adjust his entry criteria, refine his system. But deep down, underneath the rational explanations, something else is happening. A quiet erosion of confidence, a creeping sense that maybe he's not cut out for this, that maybe everyone who warned him was right. This isn't trading anymore. This is emotional survival. And here's what makes it worse. Peter doesn't realize he's built a system that practically guarantees this outcome. Not because his strategy is bad. His strategy might actually be statistically sound. His edge might be real, but his strategy requires a level of emotional stability and psychological resilience that his nervous system, as it's currently wired, simply cannot provide under stress. Now, let's introduce someone else. Someone who started in almost the exact same place as Peter. Her name is Susan. Same age, similar educational background, also trades her own account from home. But when you watch Susan trade, something's fundamentally different. Something subtle, but profound. She opens her platform at 9:30, checks her watch list, reviews her key levels, waits. An hour passes.
No setups that meet her criteria. She doesn't care. Doesn't feel anxious. Doesn't feel like she's missing out. She reads an article, answers some emails, checks back every 15 minutes. When her setup finally appears at 11:20, she enters without hesitation. No second-guessing. No mental negotiation. Just execution. The trade goes against her almost immediately. Hits her stop in 8 minutes. She exits at her predetermined level, logs the trade in her journal, notes the market context, moves on. No frustration, no revenge trade, no spiral, no emotional attachment to being right. She checks the market periodically through the afternoon. No more setups appear. She closes her platform at 3:45 and goes to the gym. Here's the part that would shock Peter if he knew. Susan's win rate is only 52%. Her average winning trade is only 1.3 times her average losing trade. On paper, her statistical edge is razor thin, barely significant. But over 12 months, she's up 43%. Consistent monthly gains. Manageable drawdowns. Peter, with his complex multi-time frame analysis and theoretical 60% win rate, is down 11% over the same period. What's the difference? Peter's equity curve looks like a heartbeat monitor during a panic attack. Violent swings, sharp drawdowns that last for weeks, recovery attempts that fail halfway and drop again. Susan's equity curve is almost boring. Steady, gradual, relentless upward drift with shallow, brief pullbacks. On paper, these two traders look almost identical. Same markets, similar starting capital, comparable theoretical edges. Inside their brains, they live on different planets. Susan understands something Peter doesn't. She designs for frequent wins over large wins, aiming for a win rate of at least 60%. Yes, this means smaller average profits per trade, but her brain needs positive feedback to maintain trust in her system. A system you can't psychologically stick with is mathematically worthless, regardless of its theoretical edge. Let's talk about what kills Peter and what saves Susan. Because this is where everything comes together. It's not the strategy. It's the equity curve the strategy produces. Peter's system might be theoretically sound. His back tests might look beautiful. His edge might be statistically significant over 1,000 trades. But it creates what behavioral finance researchers call variance stress. Long, losing streaks, infrequent wins. Prolonged periods of negative feedback. Every 3-day losing streak floods his system with cortisol. Every rare win spikes his dopamine briefly before returning to baseline. His nervous system is on a constant biochemical roller coaster. Over time, this doesn't just feel bad, it literally rewires his brain. He starts unconsciously associating trading with threat. His amygdala begins firing before he even opens a position. His decision-making quality deteriorates. His ability to follow his plan erodes. Meanwhile, Susan's system produces frequent small wins. Not every day, but often enough. Her dopamine system stays stable. Her cortisol levels remain manageable. Her prefrontal cortex stays online. She's not smarter than Peter. She's not more disciplined by some innate character trait. She's not less emotional. She's simply built a system that her nervous system can tolerate, that her biology can sustain. The strategy you can't emotionally stick with is mathematically worthless. Period. No matter how beautiful it looks in a back test. Susan also tracks her emotional state after each trade, keeping 3 columns in her trading journal. What she felt before the trade, what she felt during the trade, and what she felt after the trade. After 50 trades, she looks for patterns. Which emotions lead to her best trades? Which emotions lead to her worst? This data shows her when to trade aggressively, when to trade conservatively, and when not to trade at all. Here's what most people don't understand about professional traders, about the people actually making millions consistently. They don't worship theoretical edge. They worship survivability. Institutional traders, the ones managing real money at hedge funds and proprietary trading firms, design their systems around one primary principle: psychological sustainability over time. They know from decades of data that a system with a 65% win rate that produces 2-week losing streaks will psychologically destroy most traders, even if the math says they should be profitable. So they opt for systems with 70 or 75% win rates, even if it means smaller average wins, more frequent positive feedback, stable neurochemistry. This isn't about being soft or coddling emotions. This is about being smart enough to account for biology. Because professionals understand something retail traders don't. Your brain needs evidence that the system works, and it needs that evidence frequently enough to maintain trust. When you go 3 weeks without a win, your prefrontal cortex starts generating doubt. Your amygdala starts interpreting the situation as a threat pattern. Your cortisol stays elevated, and doubt plus elevated cortisol equals deteriorating decision quality. Retail traders chase what looks smart on paper. Professionals chase what keeps them psychologically stable enough to execute for years. Susan learned early to simplify her system ruthlessly. If she can't explain her entry and exit criteria to a 12-year-old in under 60 seconds, her system is too complex. Complexity breeds hesitation. Hesitation breeds mistakes. Mistakes breed emotional damage. The best trading systems are almost embarrassingly simple. So what does a psychologically sustainable approach actually look like in practice? It's not a new strategy. It's not a better indicator. It's a completely different relationship with the trading process itself. Susan doesn't trade to feel smart or prove anything. She trades to execute her plan and collect her edge over time. She knows that complexity feels impressive. Adding another indicator or another time frame or another confirmation signal feels like sophistication. But she also knows that complexity creates decision fatigue. And decision fatigue leads to hesitation, errors, and emotional depletion. So she uses simple rules. Clear checklists, predetermined entries and exits that require minimal real-time decision-making. When she's tempted to add another layer of analysis or refine her entry criteria to capture an extra 5% of the move, she asks herself one question: will this make execution easier or harder when I'm stressed? If it makes execution harder, she doesn't do it. Ever. Because she understands that trading isn't an intellectual exercise. It's performance under pressure. And the simpler the system, the easier it is to perform when your cortisol is rising and your dopamine is crashing and your hands are shaking. Susan creates execution checklists for every scenario. She has written down exactly what she'll do when a trade goes her way, when it goes against her, when it stagnates, and when she's unsure. She keeps these checklists laminated next to her monitor. When emotions run high, Her checklists become her anchor to rational decision-making. She's also learned something that Peter hasn't yet. Boredom is a competitive advantage. Most traders quit not because they lose all their money, but because they can't tolerate the emotional flatness of disciplined trading. They need the dopamine hit, the excitement, the feeling of being active and engaged and in the game. But that need for stimulation is exactly what destroys them, because it drives overtrading, forcing trades, chasing, revenge trading. Susan has spent 2 years consciously rewiring her relationship with boredom, training herself to associate waiting with success, to feel pride in the trades she didn't take. It was uncomfortable at first. Her brain kept screaming that she was missing opportunities, that real traders are active. But she persisted. And gradually, her nervous system adapted. Boredom became safety. Inaction became strength. Once that shift happened, everything changed. Susan keeps what she calls a non-trade journal. Every time she wants to take a trade but decides not to because it doesn't meet her criteria, she writes it down. She tracks what would have happened if she had taken it. After 50 non-trades, she has overwhelming evidence that not trading is often the most profitable decision she can make. The millionaire trader doesn't make better decisions. He makes fewer emotional ones. Think about that statement. Really sit with it. The wealth isn't built through genius entries or perfect exits or catching the exact top and bottom. It's built through the accumulation of non-emotional executions. Trade after trade after trade, day after day, month after month, year after year. Susan doesn't win because she's smarter than Peter or has a better strategy. She wins because her nervous system stays regulated. Her parasympathetic nervous system, the part responsible for calm and clarity, remains dominant most of the time. Peter's sympathetic nervous system, the fight-or-flight response, is constantly activated. Over 1,000 trades, that difference compounds into completely different outcomes. Different account balances, different psychological states, different futures. Most traders don't fail because they aren't smart enough, or didn't study hard enough, or didn't find the right strategy. They fail because they couldn't become boring enough to succeed. Susan developed a pre-trading routine that calms her nervous system. 5 minutes of deep breathing, reviewing her rules, visualizing successful execution. Her routine is the same every single day. It signals to her brain that she's entering a state of focused performance, not emotional chaos. Here's the uncomfortable part. The part where you stop reading about Peter and Susan and start thinking about yourself. What kind of equity curve can you actually survive? Not the one that looks best in a back test. Not the one with the highest theoretical return. The one that won't break you psychologically after 3 losing weeks in a row. Which parts of your trading aren't strategy problems, but emotion problems? When you take that revenge trade at 2:47 p.m., or exit early because you're scared, or skip your setup because you're still hurt from yesterday's loss, that's not the market. That's you. Are you building a system your nervous system can actually tolerate? Or are you building the system you think you should be able to tolerate and then punishing yourself when you can't? Is trading helping you grow? Or is it giving you a place to run from something else? A place to prove something, a place to avoid something. These questions hurt. They're supposed to hurt, but they're the only questions that actually matter. Because the market doesn't care about your potential, it only cares about your execution, and your execution is downstream from your neurology. Here's what this all means for you right now, today. You've spent months or years believing that the gap between you and millionaire traders is technical knowledge. That if you could just find the right pattern or indicator or time frame or confirmation signal, everything would click into place. But the gap isn't technical, it's psychological. And closing that gap doesn't require more knowledge. It requires more honesty. You need to stop building strategies for the trader you wish you were and start building them for the human who actually shows up when money is on the line. that human gets scared, gets greedy, gets bored, gets desperate, gets impatient, gets emotional. And any system that doesn't account for that reality will fail. Not because the system is bad, but because you're human. The traders who make it aren't the ones who transcend their humanity through discipline and willpower. They're the ones who design around it with intelligence and self-awareness. They build systems that produce frequent wins because they know their brain needs positive feedback to maintain trust. They keep their rules simple because they know complexity breeds hesitation and decision fatigue. They accept boredom because they know excitement is expensive. And they measure success not primarily in dollars, but in how well they executed their plan, regardless of outcome. Because dollars are a lagging indicator. They're the result of many variables, some outside your control. Execution is the only thing you directly control. In trading, survival isn't the first skill you need to learn. It's the only skill that actually matters in the long run. Everything else, the edge, the opportunity, the wealth, the freedom, all of it comes after you learn to survive your own mind. Your next breakthrough won't come from a better entry technique. It will come from a better understanding of yourself, of your triggers, your patterns, your breaking points. The strategy is just a map, but you're the one who has to walk the path. And if you can't walk it without breaking, the map is worthless. So ask yourself right now, in this moment, am I trading the market, or am I trading my emotions? Because until you can answer that honestly, until you can see the truth clearly, nothing else will change. No new strategy will help. No new course will save you. The millionaire mindset isn't complicated or secret or expensive. It's just simple enough that most traders never commit to it. Simple enough that it feels insufficient. Simple enough that it requires you to trust the process more than the outcome. And that's the hardest thing any trader will ever do. Not because it's complex, but because it's simple.